A normal distribution is called mesokurtic. This has a kurtosis of 3. A leptokurtic distribution has a kurtosis greater than 3, and the main point is that with a leptokurtic distribution we have fatter tails, and this is also more peaked. The more peaked part is not an issue. The real issue is fatter tails. Fatter tails means that there is a higher, which obviously is not good for investors. And then the application of utility theory to portfolio selection. Let's start with the concept of risk aversion. Risk aversion refers to the behavior of investors of preferring less risk to more risk. In other words, for a rational investor, if two investment options exist, A and B, both offer the same return, then all else equal, the investor will prefer the option that offers lower risk. In this particular case, let's say option A or investment A has relatively low risk and option B has relatively high risk, then a normal risk-averse investor would prefer investment A over B, even though A and B have the same expected return. When we say high risk aversion, this is the same as saying low risk tolerance. A normal investor is risk averse, which is what we talked about, but there can be other profiles. A risk neutral investor doesn't care about risk. In other words, for a risk neutral investor, investment A and B would be the same. A risk seeking investor actually prefers more risk to less risk, all else equal. Let us quantify this concept now. We will talk about utility theory and indifference curves. We can measure the utility of an investment to a particular investor using this formula. The utility is equal to the expected return minus half of A. A is a measure of risk aversion times sigma squared. This is a measure of the risk of the investment. If you look at this formula carefully, the utility of a particular investment will be high if the expected return from that investment is high. That makes sense. And then we have a negative sign. Before I come to the risk aversion, which is investor specific, I'll look at the risk over here. If the risk is high, then because of that negative, the utility comes down. For an investor with a high degree of risk aversion, where A would then be a relatively high number, then a given level of risk is multiplied by this high risk aversion, so the overall impact would be more negative. As a word of caution, when you use this formula, use only decimals. So if you are given an expected return number in percent, you need to convert that to decimal. Standard deviation also should be converted into decimal. Let's do a simple exercise. An investor has a risk aversion of 2. That's what you will plug over here. In the real world, these numbers are difficult to come up with, but in the exam world, this will be given to you. So that's how we will operate. The investor has risk aversion equal to 2 and owns a risk-free asset returning 5%. What is the utility? All we need to do is plug into this formula. The utility of an investment is equal to the expected return, 5%. And remember, we need to use decimal. So you do 0.05 minus half of A, which is 2, but then it's risk-free. For a risk-free investment, the risk or the sigma is 0, so minus 0. The answer, therefore, is 0.05. If I were to plot this over here, I'd say at a risk of 0, the utility is 0.05. This investor is considering an asset with sigma equal to 10%. So this is a risky asset. At what level of return will he have the same utility? We have already established the utility. The utility is 0.05. So you can say 0.05 is equal to the expected return, which is what we are trying to compute. Let's say that is x, minus half of A, which is 2, multiplied by sigma squared, that's given, and we need to work in decimal, so we do 0.1 squared. We solve for x and we get 0.06. What this means is that at a risk of 10% or 0.1, the investor will be equally happy as long as he gets a return of 0.06. So that would be this point over here. And if you think about it, this makes sense. He had a certain level of happiness at this point. That level of happiness measured by the utility is 0.05. With this higher risk investment, to remain equally happy, he needs a higher return. That higher return is 6%. The line which connects all these points where the investor is equally happy is called an indifference curve. This is the indifference curve for the investor where the level of utility is 0.05. The indifference curve, or one particular indifference curve, tells us the different risk and return numbers at which the investor is equally happy. The indifference curve is a graphical depiction of the utility function. Next question. Given a choice between a risk-free asset and a stock with an expected return of 10% and sigma equal to 2, what will he prefer? What you need to do is compute the utility for this investment. The utility is equal to the expected return, which is 0.1, minus half times the risk aversion, which is 2, multiplied by sigma squared, which in this case is 0.2 squared. If we calculate this, we get 0.06. This utility number is higher than the utility of 0.05, which means that the investor will be happier with this option. If we are to put this on a picture over here at a standard deviation of 0.2, the utility is 0.6. With this investment, we have an expected return of 10%, sigma equal to 20. So it will plot over here. Notice that this point is above the original indifference curve, and clearly the investor is going to be happier on this curve because the utility is 0.06, which we calculated over here. That is greater than the original utility of 0.05. Notice that the indifference curves will generally point northeast because to remain equally happy, additional risk needs to be compensated with higher returns. Another point is that as indifference curves move northwest, the investor is happier. So those are the main points related to indifference curves for a given investor. Key point is to remember this formula and remember to do calculations in decimals. Now let's look at the indifference curves for various types of investors. Here again is the utility function. The utility is the expected return minus half times A, which is the risk aversion, times sigma squared. We have expected return on the y-axis, risk or standard deviation on the x. For somebody who is risk neutral, the utility is the same regardless of the level of risk. Because he is risk neutral, he doesn't care about risk. For a risk averse investor, the utility functions will look like this. Because for a risk averse investor, when he takes more risk, he needs to be compensated with more return. So this is the indifference curve for a risk averse investor. What about a risk seeking investor? For him, the indifference curves will look like this, where he likes more risk. So to be equally happy with more risk, he is willing to live with a lower return. This is not a normal scenario. Coming back to risk averse, most investors are risk averse, and finance theory assumes that investors are risk averse, but the degree of risk aversion can vary. Let's say that this particular investor has a risk aversion equal to 2. What if we have another investor who has a risk aversion equal to 3? We will use a different color for him. Here the risk aversion is higher, so the indifference curve will be steeper. Since this person is more risk averse, to take on a certain amount of risk, he needs to get a higher compensation in terms of greater return. That is why if the risk aversion is higher, the indifference curve is going to be steeper. If you have another investor who is not very risk averse, for him the indifference curve will be less steep. We will now look at the application of utility theory to portfolio selection. Consider a simple portfolio of a risk-free asset and a risky asset. Plot the expected return of the portfolio against the risk of the portfolio for different weights of the two assets. So here is our portfolio. We have the risk-free asset, let's say this is asset 1, and a risky asset, let's say that is asset 2. The risk-free rate is 5%. Since this is risk-free, the risk is 0. For our risky asset, we have a return of 10% and a risk of 20%. What is the expected return of the portfolio? The expected return is simply a weighted average. If we have 100% weight put in the risk-free asset, then the return of the portfolio will be 5%. If we have 100% weight in the risky asset, then
very initial video with 1 and multiplied by 0.22 squared. Function is, I mean, it's a very nice theoretical construct. Function. In this video, we're continuing the numbers in the portfolio would be its expected return. 27 squared optimize over here with a 16% expected return. It doesn't matter. For them, standard deviation is not going to be important. Which is already in front will give a positive one times 14 plus 0.35 squared.
Portfolio management and overview. In this reading, we will talk about a portfolio approach to investing. We'll then discuss the steps in the portfolio management process. Section 4 deals with different types of investors. Here, what is the expected return of the portfolio? We will now look at the application of utility theory to portfolio selection. Consider a simple portfolio of a risk-free asset and a risky asset. Plot the expected return of the portfolio against the risk of the portfolio for different weights of the two assets. So here is our portfolio. We have the risk-free asset. Let's say this is asset 1 and a risky asset. Let's say that is asset 2. The risk-free rate is 5%. Since this is risk-free, the risk is 0. For our risky asset, we have a return of 10% and a risk of 20%. What is the expected return of the portfolio? The expected return is simply a weighted average. If we have 100% weight put in the risk-free asset, then the return of the portfolio will be 5%. If we have 100% weight in the risky asset, then the return will be 10%. If we put a 50-50 weight, then the return will be an average of these two, which is 7.5%. You have done this several times. What about the risk of the overall portfolio? Here is a formula that you should be familiar with by now. The risk of a portfolio is given by this expression. But notice, given that sigma is 0 for asset 1, this expression becomes a lot simpler. Sigma is 1, so this becomes 0, and
Return at a portfolio level, there will be an important formula here. Hopefully you won't have to use it in the exam. Nevertheless, there will also be sort of inferences, learnings in this video that you absolutely have to know, very fundamental stuff. So I'm going to walk through this via numerical examples. Let's assume that an investor holds a 2-asset portfolio, as you can see, and it's composed of just 2 stocks, Y and Z, with the following risk and return characteristics. So you've got for Y and Z, respectively, their expected return and expected standard deviation. Now, I'm not going to show you how to compute standard deviation. We did that within quantitative methods. And actually, later on in the questions, we're also going to encounter things like covariance and correlation. Now, once again, I'm not going to walk through how those are computed or what they are, aside from some, brief reference or brief mention. Why? Because we've done it within quantitative methods, so I don't want to repeat the same stuff over and over again. Now, question number 1 says the expected return on an equally weighted portfolio of stocks Y and Z is closest to. Okay. This is a really simple question. You don't expect to get something like this in the exam, but irrespective of what the covariance between these stocks is, what's the degree to which they actually move together or indeed not, irrespective of their correlation, the expected return on a portfolio is always the weighted average of the returns of the constituent components. So let me just write this down. Portfolio return always equals, or expected return right here, always equals just simply the weighted average. The weights are going to come from the from the share of the portfolio occupied by each company. In this case, it's equally weighted, meaning 50% and 50%. Okay, weighted average of the constituent returns. So the expected return on this specific portfolio would be take the weight of stock Y, multiply by its expected return, add the weight of stock Z, multiply by its this should have been a Z, not a P, its expected return, and off you go. Well, this should be easy. Equally weighted means 50% weight for each stock, so 0.5 multiplied by the expected return of the first one, 4%, and another 0.5 multiplied by the expected return of the second. And of course, this will give us a value which is smack in the middle between 4 and 8. So that's going to give 6%. We don't need to take the calculator out for this. Answer C, nice and easy. Don't expect to get a question like this unless you're extremely lucky. Now, for the second question, we're going to focus on the same numbers, or we're going to utilize the same numbers, but we're given a correlation coefficient, and we're told the correlation between stocks and Y and Z is perfectly positive, meaning correlation equals +1. Now, correlation is a standardized measure of covariance, or a standardized covariance. It can only take on values of between -1 and +1, where +1 is perfect positive correlation, -1 is perfect negative correlation, 0 means no linear relationship between the, in this case, between the stocks and their behavior. It's a measure of how, of the strength of the linear relationship between, in this case, two stocks, more within the section, within the quantitative methods section of the curriculum, where we explore this in a lot of detail. Now, we're also given the weights for the two stocks, 70% for Y, 30% for Z, so it's no longer 50-50, and we're asked what's the expected standard deviation of the portfolio. Okay, and here comes the formula that you unfortunately need to know. It's a little bit sort of awkward, but everybody who does anything in finance had to go through this. It's a cornerstone of what we call modern portfolio theory. So when trying to measure and gauge portfolio risk, this is for a two-asset portfolio, it becomes a much more onerous formula when we do it for 3, 4, or even more assets, right? The way to measure the risk is to look at standard deviation or variance. Later on, we'll be swapping that for beta on the CAPM model, but for now, we focus on the variance of the portfolio, or standard deviation squared. And here comes the formula. Take the weight of Y, square it, multiply by the variance of Y, standard deviation squared of Y, add the weight of Z, the second stock, square that, multiply it by the variance of Z. So as you can see, these two terms so far are sort of mirror images of one another. And then comes 2 times the weight of Y times the weight of Z times the covariance between them. So the degree to which they move together in a linear way. Covariance is sometimes going to be provided to you, but not always. So here we're given the correlation, and correlation of 1 by no means actually implies that covariance is equal to 1. equation which they move together in a linear way. Covariance is sometimes going to be provided to you, but not always. So here we're given the correlation, and correlation of 1 by no means actually implies that covariance is equal to 1. Covariance equals the correlation between y and z multiplied by the standard deviation of y and the standard deviation of z. So you may need to work that in that way. Now, if correlation, like over here, is actually +1, as it is in this specific case, things actually simplify, because instead of having covariance, what you're going to have over here is, this becomes 1, so it doesn't exist. You just get the sigma of y times the sigma of z. And depending on how long ago you studied mathematics in school and to what level, you should recognize that this very nicely simplifies to a quadratic equation, which is wy, weight of y, times the beta of y, plus wz times the beta of z squared. If you were to write this out, you would get, obviously substituting covariance for just this, it would perfectly work out this way in the long form. Now, you need to have a certain level of mathematical awareness when you take the CFA Level 1 exam. It doesn't have to be huge, but there are certain things that are useful to remember back from school, or recall back from school. Now, because we are asked for the expected standard deviation, and this is an expression for portfolio variance, in order to calculate standard deviation, we just take the square root of this, and that's our standard deviation. And we can with confidence say that therefore it is going to be equal to wy times sigma y plus wz times sigma z, and we just kind of dropped the square sign here. We took the square root of from what was stated above. So this becomes a really, really simple thing. Only and only when correlation between the two assets is perfectly positive, +1, is the standard deviation of the portfolio equals the weighted average of, so this is portfolio, becomes the weighted average of the standard deviations of the component assets, or their returns component assets. So take the weight of one asset, 70% for asset Y, 0.7, multiply that by its standard deviation, 1.826%. Okay, 1.826%. Add the weight of the second asset, 30%, and multiply that by its standard deviation, and that's the 3.651. 3.651%, and you get yourself a simple weighted average. So just like previously I told you about the computing the expected return. But this simplification as it is in this specific case, things actually simplify, because instead of having covariance, what you're going to have over here is, this becomes 1, so it doesn't exist. You just get the sigma of y times the sigma of z. And depending on how long ago you studied mathematics in school and to what level, you should recognize that this very nicely simplifies to a quadratic equation, which is wy, weight of y, times the beta of y, plus wz times the beta of z squared. If you were to write this out, you would get, obviously substituting covariance for just this, it would perfectly work out this way in the long form. Now, you need to have a certain level of mathematical awareness when you take this.
And this expression becomes 0 for 2. We will now look at the application of utility theory to portfolio selection. Consider a simple portfolio of a risk-free asset and a risky asset. Plot the expected return of the portfolio against the risk of the portfolio for different weights of the two assets. So here is our portfolio. We have the risk-free asset. Let's say this is asset 1, and a risky asset. Let's say that is asset 2. The risk-free rate is 5%. Since this is risk-free, the risk is 0. For our risky asset, we have a return of 10% and a risk of 20%. What is the expected return of the portfolio? The expected return is simply a weighted average. If we have 100% weight put in the risk-free asset, then the return of the portfolio will be 5%. If we have 100% weight in the risky asset, then the return will be 10%. If we put a 50-50 weight, then the return will be an average of these two, which is 7.5%. You have done this several times. What about the risk of the overall portfolio? Here is a formula that you should be familiar with by now. The risk of a portfolio is given by this expression, but notice, given that sigma is 0 for asset 1, this expression becomes a lot simpler. Sigma is 1, so this becomes 0. And this expression becomes 0 for two reasons. The sigma 1 is 0, plus the correlation is also 0, because the correlation of any asset with a risk-free asset is 0. In other words, the risk of the portfolio is given by the square root of W2, which is our risky asset, weight of the risky asset, times is given by this expression. But notice, given that sigma is 0 for asset 1, this expression becomes a lot simpler. Sigma is 1, so this becomes 0, and this expression becomes 0 for two reasons. The sigma 1 is 0, plus the correlation is also 0, because the correlation of any asset with a risk-free asset is 0. In other words, the risk of the portfolio is given by the square root of W2, which is our risky asset, weight of the risky asset, times sigma 2 squared. When you take the square root, you are simply left with W2 times sigma 2. And as we've said, the expected return of the portfolio is simply the weighted average of the returns of the two assets. Now we are asked to plot the expected return for different weights of the two assets. Here is what you should get. If W2 is 0, that means you have 0 weight in the risky asset and all your weight in the risk-free asset, then the return is simply 5% and the risk is 0. That's this point over here. As you move to the right, you put more weight in the risky asset. Let's say the weightage in the risky asset is 0.25. The return on the portfolio, the risk on the portfolio is going to be 0.25 into sigma 2, that's 0.25 into 20, which is 5%. So as you move to a weightage of 0.25 in the risky asset, the risk becomes 5% and the return is 6.25%. As you plug in more numbers, let's just take this one over here, 0.5 weightage in the risky asset. The risk of the portfolio is 10%. So we are at this point with the expected return of 7.5%. When you plot this out, you notice that you simply have this straight line over here. As you are moving northeast on this line, the weightage of the risky asset is increasing. At this point, you are 100% invested in the risky asset. The return will be 10% and the risk will be 20%. Let us now derive the formula of this line. If you remember your basic high school maths, the equation for a straight line is given by y is equal to mx plus c, where m is the slope and c is the intercept on the y-axis. If you think about this line, the y-axis is your ri. This is equal to the slope. The slope is the change in y, which is Ri minus Rf divided by the change in x, which is simply sigma I. So Ri minus Rf over sigma I, this is
Hi there. So now we'll be Hi there. So now we'll be starting with a new reading of portfolio management, which is an overview of the whole curriculum. So portfolio management क्या होता है? We have already discussed basically portfolios are a bunch of asset classes that are made suiting to the basically best suited for the investor, right? So we'll be understanding के investor क्या होते हैं, portfolios क्या होते हैं, assets क्या होते हैं. So all those things will be discussed on and off during the curriculum. First of all, we need to understand what is portfolio perspective. ठीक है? अगर मेरी handwriting नहीं समझ में आ रही है तो Hi there. So now we'll be understanding what are indifference curves. ठीक है? So investors could be of three types. Risk seeking लिया है. I have taken one particular, right? हमको तो क्या देखना है वो. Hi there. So
हेलो एवरीवन, क्या हालचाल। वेलकम टू क्लास 10 फॉर CFA लेवल 1 पोर्टफोलियो मैनेजमेंट। आज के क्लास में हम एक नया डिस्कशन स्टार्ट करेंगे और चैप्टर का नाम है इंट्रोडक्शन टू रिस्क मैनेजमेंट। ठीक है।
Hello everyone, welcome to another video for CFA level 1. In today's class, we will be starting an absolute new topic in portfolio management, and the name of the topic, as you guys can see, is portfolio risk and return part 1. Why part 1? Because in your CFA curriculum, portfolio risk and return is divided into two readings, part 1 and part 2. So we will take up both of them separately. Today we will start with portfolio management risk and return part 1. Now before lot of numerical concept, a lot of numericals in place, and it is a paradise for those who like maths, right? But don't worry, guys. Those who are not good in maths, I am here for you. I'll make each and every concept very easy to understand, very logical, so it will not come hard on you. Okay, guys. So let us start. The first topic, more from an introduction point of view, tells us how we can classify an investor. So basically, portfolio management says that investors can be classified. We take concept, we will understand the various measures of return. 150, this 50 is the capital appreciation, and this R1 is in the arithmetic mean return. We are ignoring the fact as to how much of investment. Hello everyone, welcome to another video for CFA. This video will be small and will be a continuation to the course. In order to make this investment and get the return, it earned $1,120 and had to pay $20 as commission, in terms of transaction cost, in terms of charges, in terms of brokerage, and left with $1,100. Okay. Now, since it has got $1,100 and $50 is the management fees, the amount which investor gets is $1,050. So this is the entire transaction. Now, what is gross fees? In this situation, gross return will be 1,100 divided by 1,000 minus 1,000 into 100, which is 10%. Hello and welcome everyone to another video for CFA Level 1. In today's class, we will be completing the risk measures of portfolio management. So we will be doing risk measures, right? Now, before we do risk measures, we need to understand what is risk from an investment paralysis and in general, okay? And this is something which CFA Institute expects you to understand without even giving this in the curriculum. So because it assumes that it is a basic thing that you should know what is a risk, okay? What we will start with is we will understand uncertainty, and then we will understand risk, okay? Because if you would have seen in the normal conversational patterns, uncertainty and risk are often interchanged. They are often assumed to be same, correct? So what is uncertainty and what is risk? Uncertainty refers to those events, the outcome of which is unknown, okay? Now, given the outcome is unknown, okay, there are only two possibilities which can happen. Either the outcome will be favorable or it can be unfavorable, correct? Either the outcome will be favorable or it can be unfavorable. Are we clear with this? So, when we talk about risk, we are considering the unfavorable side. We are not considering the favorable angle. So, basically, risk are those uncertainties which when occur is unfavorable to us, okay? There are various definitions of risks in terms of investment, in terms of business, in terms of a lot of things. We are not going into the bookish definition of risk. Bookish definition of risk is something which we are not entering into, okay? What we are understanding is a general overlay about risk. What does risk means? So first we will understand what is uncertainty. What is uncertainty? We discussed that uncertainty means events, outcome of which is unknown. Now that outcome can be favorable and it can be unfavorable. When we talk about risk, we are only considering the unfavorable outcome. So basically, those uncertainty which result into unfavorable outcomes are risk. Are we clear? So for example, let me give a basic example. If I have made an investment in the stock market, okay? If I have made an investment in the stock market, I expect a return. Now, return expectation and all we know because we have done this topic in corporate finance. So I will not be repeating this again. What is return expectation and what is this? If you want, you can refer my previous videos, okay? A couple of videos back, you can refer it. So investment stock market, if my expected return is 12%. Now over here, what will happen? There are three situations. Either the return will be greater than 12, or the return will be equal to 12, or the return will be less than 12, correct? when we talk about risk, we are only bothered about this situation where my return is lower than 12. We don't factor in the greater than, we don't factor in the equal to, because those are not unfavorable for us. I was expecting 12, I got 12, I'm okay. I was expecting 12, I got more, it is even more good for us, even more good for me. So I'm not considering that. So where does the risk comes in? Risk comes in when the realized return is lower than the expected. So this is the area of risk. This is the area of risk. Are we clear? Guys, are we clear? Okay. Now having this background of risk, now we know what is risk. Thus, there are risk measures. What are risk measures? Risk measures are nothing but quantification of possible unfavorable events. What are risk measures? Risk measures are nothing but quantification of possible unfavorable events in respect of portfolio investment, in respect of a portfolio. And when you tell in respect of a portfolio, what does it mean? When we say in respect of a portfolio, what is the risk we are talking about? The risk is not being able to achieve the expected return. So what we are basically doing is that we are quantifying the possibility that the investments that we are making or the portfolio that we are creating will not be able to achieve the expected return. Okay, I will repeat it once again for the benefit of the audience. Risk measures in portfolio management means quantification of the possibility that the portfolio that I have created is unable to achieve the expected return. Are we clear? Guys, are we clear? Okay. So basically, we will understand three major concepts: variance, standard deviation, and correlation. Okay, all of these concepts are statistical concepts. Okay, so we will not get into deep statistics, but we will understand some of these things in a very layman terms. Okay, now let us get back to the material and see. Okay, guys, now let us see. The first and the foremost, we are given with variance of individual security return. What does it mean? Variance of individual security return. It means that we are quantifying the risk with respect to return of an individual security. Okay, it measures the variability of distribution of return about its mean or expected value. Okay, suppose I have an investment in stock A. Okay, suppose in year 2010, 2011, 2012, 2013. Is it visible? No, it is not visible. Suppose I have invested in a stock A. Okay, 2010, 2011, 2012, 2013, 2014, 2015, 2000. Let us take this 6 years as an example. Okay, 5% or 10%, 15%. Suppose in year 10 the return was 15. Suppose in year 11 the return was suppose 7. In year 2012 it was suppose 10. In year 2013 suppose it was 12. In year 14 suppose it was 15. In year 15 suppose it was 5. And in year 2016 suppose it was year 10. Okay. So how my line graph for the return will look like? It will look like this. Okay. Okay. Now using this return for the multiple year, we can calculate an arithmetic mean around it. Okay. So these are actual return and these are mean return. Okay. Now you see in every year there is a difference between the actual mean and the mean return, actual return and the mean return, correct? This difference is known as variability. Okay, and a single number which indicates this variability is known as variance. Variance is no hi-fi science. If you are afraid with statistics because of your previous, whatever you have done or whatever you have been through, trust me guys, statistics is as logical as it can get. Just you need to visualize it. See, we have drawn a simple graph. We had 6 years of data. We had 6 years of return. We simply plotted it. We did an arithmetic mean. We got the arithmetic mean. Now, when we plotted the arithmetic mean in the same graph, we saw that there is a difference between the actual mean and the arithmetic mean, correct? Now, because of the difference, we can say there is a variability. If we are saying there was no variability, then the actual return should also have been like this, straight, correct? But that is not the case. You and I both know, right? Now, this is the variability, and the number which indicates this variability is known as variance. Are we clear? Okay. The formula for this variance is, and variance is either shown as VAR, variance is either shown as VAR, or this is sigma square. This is known as sigma. Again, guys, if you are worried or if you get intimidated by, these words, don't need to remember it. Simply call it variance. Okay. But if you want to know, that is why I'm saying we don't even need to know this is sigma. So, guys, don't worry about, mathematical formulas, mathematical nomenclatures. Okay. We will call it variance. Okay. What is variance? This is nothing but summation. So, when you add multiple things like 1 plus 2 plus 3 plus 4, this is a signature for that. Summation of RT. What is RT? RT is the actual return minus mu. What is mu? This is mu. Again, we don't need to get intimidated. This is mu. This is nothing but the mean return. Okay. This is the entire subtraction is then squared up, and each of this number is then added, divided by t. What is t? T is the number of observation. What is the number of observation? In this example, number of observation is the number of years. We will count how many years it is. 1, 2, 3, 4, 5, 6, 7. So over here, t will be 7. What will be mu? Mu will be this line. This line. Mu will be this line. And what will be RT? RT will be these respective points. Are we clear? So the formula is, so for example, if, guys, I'm not claiming that this will be right. If the arithmetic mean over here is 10, okay, then the way it will work out is 15 minus 10 whole square plus, suppose this is 7, yes, 7 minus 10 whole square plus, suppose this is 10, 10 minus 10 whole square plus, this is 12, 12 minus 10 whole square plus 15 minus 10 whole square plus 5 minus 10 whole square. This all divided by 7. When the work is shown like this, this entire can be shown as summation RT, that is actual return, minus the mean return or the mu whole square divided by t. Are we clear, guys? Are we clear with the formula for variance and what does variance mean? Okay. The next measure which we will study is simple standard deviation. Standard deviation is simple. It is the square root of variance. So we both know how to compute variance. Okay. We both know how to compute variance. We will compute the variance, and for standard deviation, we will divide it by, we will square root the variance. No hi-fi thing. Very logical. So basically what the definition for variance is, the same definition applies for standard deviation. It shows variability around the mean. Are we clear, guys? Are we clear? So far, so good. Then we come on to something known as sample variance. Then we come to another thing, sample variance. What is sample variance? Same formula, but the denominator is t minus 1. Guys, this is usually not used. So don't think about it a lot. Sample, just hear the word sample variance, t minus 1. Then we come to portfolio variance of two securities. Okay, now this is important. See, the entire working that we did over here was for individual security. Okay, suppose assume a bag which has two security A, security B. Okay, security will A have its own risk, Yes or no, guys? Yes. Security B will have its own risk. Correct. Now they too have individual risks. Okay. But what about the risk of this packet? When both A and B come together, okay, what about the risk of this packet? Are you understanding? Suppose in security A, I have invested 100 rupees, $100. In security B, I have invested $200. Okay. As an individual, as a person, I can find the risk of security A. I can find the risk of security B. Okay. So I can say that X is the risk for $100 of investment in security A. Y is the risk of $200 of investment in security B. But what do I say about the risk of the $300 that I have invested in total? How will I do it? I can say individually the risk of $100. I can say individually the risk of $200. But what do I say for the risk of this $300? That is the combination of A and B. What is the risk of this entire packet? What is the risk about this entire packet of $300? So now that we will understand, how do we compute it? Okay. And very logical. Okay. Nothing, illogical about it. See, if this is the packet, okay, security A, security B, if this is the packet, the risk of this packet, and suppose we continue with the same example, $100 and $200, okay, can we say the risk of this packet depends on risk on security A as well as and risk on security B? Since the packet is comprised of security A and security B, can we say the risk of this packet is dependent upon the risk of security A and security B, which are which are the constituent of the packets? Can we say it? So can we say the risk of the packet is dependent upon the risk of security A and security B? Okay. Now the second question. The risk is more dependent on which of the constituent? So the risk of the packet is more dependent on which of the security? The risk of the packet is more dependent on whether it is dependent more on security A or whether it is dependent more on security B. We need to understand. Similar example I will take. Suppose you take a packet, okay. Suppose you take a small pebble and other you take a large pebble, okay. In that packet, and suppose we move it across the road. The movement of that packet across the road, whether it is influenced by the bigger pebble or whether it is influenced more by the smaller pebble, it will be influenced more by the bigger pebble, right? So the risk of packet will be influenced more by the security which has a higher weightage in terms of money, correct? So definitely the weights in terms of money will be used. So risk plus weight in packet, correct? Risk plus weight in packet. Now there is a third component as well. What is that component? The third component and the most interesting part is that, see, A and B are separate security with their own risk, okay? Till now we have established that the risk of the packet will be dependent on the risk of the securities. At the same time, the weightage they carry in that packet. But the third component which is there is that how these two securities interact with each other. Because the risk of the packet is nothing but the risk of individual securities and how these securities interact with each other. Because financial world is quite related to each other. Okay. Movement of one stock or movement of one security will influence the movement of another. So for example, if I and you are walking in a street, okay, and if I say that my movement also ensures your movement, then can we say that, we two influence each other? Similarly, stock A and stock B, the way they interact in the market also will influence the risk of the packet. This interaction, which we are talking about, this interaction is known as correlation. This interaction is known as correlation. Are we clear? This interaction between the securities are known as correlation. Now let us go and look at the formula. Portfolio variance. Variance of securities in case of two risky assets. W1 square plus sigma 1 square. What is this? This is weight of the first security square into weight of the second security square plus W2 square into sigma 2 square, which is weight of the second security square into risk of the second security square or sigma, plus 2 into weight 1 into weight 2 into covariance between the two security. This covariance is nothing but the interaction of two securities. Or alternate formula, The first two items is same. The third item changes. Instead of correlation, we have sigma 1, sigma 2 into, instead of covariance, we have sigma 1, sigma 2 into correlation, interaction between the two securities. Are we clear? Now this formula comes from a very basic formula which we would have done in class 8, 9. Are we clear? Now this formula comes from a very basic formula which we would have done in class 8, 9. Okay, that is a plus b whole square. What is a plus b whole square? It is a square plus b square plus 2ab. Okay. Now when we have to do weighted average of something, we know how to calculate weighted average. What will be the number? What will be the weighted average in case of risk? Weight into risk plus weight into risk. Okay. What did we do over here? Weight into risk. Okay. What did we take in terms of risk? We take standard deviation. Okay. Plus weight into standard deviation. Okay. Since we had to compute the variance, we squared it. Now what is the term? Weight 1 SD1 square plus weight 2 SD2 square plus 2 into weight 1 weight 2 SD1 SD2, and then the third term which comes in is the interaction between them. This opens up to become weight 1 square SD1 square plus weight 2 square SD2 square plus 2 into weight 1 weight 2 SD1 SD2 sigma. Are we clear? Are we clear how this big looking formula has come from a small elementary school formula, a plus b whole square? Now, having understood this, we will deep dive into what correlation means and what covariance mean and how it is calculated. Are we clear? Now we come to covariance. Okay, guys, let's do one thing. We will take covariance in the next class. Okay, let's keep it till today. So just one more thing: portfolio standard deviation. Portfolio standard deviation. Hello everyone, welcome to another video for CFA. This video will be small and will be a continuation to the previous video because there was some technical glitch and we could not complete the return concept completely. So, hello and welcome everyone to another video for CFA level 1. In today's video, we will be covering 2-3 topics, primarily around correlation and covariance. Okay. In the previous class, we have started about risk concepts in portfolio management. We have done standard deviation, we have seen variance, we have seen for individual securities, and we have seen for the portfolio. Okay. When we were doing it for the portfolio, we saw that when two securities are included in a portfolio, the risk of the portfolio is also dependent upon the correlation or the covariance between the two securities, right? Now we will understand today what is correlation or a covariance. So these terms are not interchangeable, but yeah, what they mean. Okay. So let us start. Covariance of two securities. What is covariance of two securities? A covariance of two securities measures the extent to which two variables move together over a period of time. Positive covariance is when they move together, and negative covariance means when they move in opposite directions. Covariance of 0 indicates that there is no linear relationship. We should understand there is no linear relationship between the two variables. So what does covariance mean? Now we will see with the help of an example. Okay. What is covariance? Now again, as we have discussed in the previous class, covariance is a concept which is based out of statistics, but we are applying that into portfolio management. That is why in our context, we look at covariance between two securities. However, originally, whenever there is a discussion of covariance, we say covariance between two variables. What are variables? Variables are those whose values keeps on changing. Values keeps on changing. Are we clear? Variables are those whose value keep on changing. Correct? Now what does covariance means? Covariance means, suppose we have two securities, security S1 and security S2. Okay. If we say security S1's return was 10% and securities S2 return was 11%. Okay. If we say suppose a particular event has happened in the economy, any event, it can be, for example, the economic conditions being nice or the consumption increasing or, government making a particular investment, anything suppose which can happen, because of which the returns have been continuously increasing. Okay. Over here as well, 13, 15, 18, okay, 16, this becomes 20, so on and so forth. Suppose the returns for security S1 and S2 has been increasing. Now, if you look at this example, S2 is increasing at the same, sorry, S1 is increasing, at the same time S2 is also increasing. What does it mean? It means that, can we say S1 and S2 are moving in the same direction? What does it mean? It means any particular event. What does it mean? The same direction. We will understand. What does it mean? It means any particular event which will result in increase in S1 or S2, okay, will also cause the other security. What is the other security? If we are talking about S1, the other security is S2, and if we are talking about S2, the other security is S1. So what did we see? Since they are moving in the same direction, it means that any particular event which causes S1 or S2 to increase, it will also result in the other security to move in the same direction or to increase, to move in same direction or increase, and vice versa. What is vice versa means? It means that if a particular event will cause S1 or S2 to decrease, then the other security, which means in case of S1 it will be S2 and in case of S2 it will be S1, that will also decrease, which means a particular event will result in the return of the security moving in the same direction. Okay, this situation is known as positive covariance. Okay, now we take another example. Suppose we have two securities S1, let us take S4 and S3. Suppose because of an event, the returns for S3 has increased, okay, from 10, 11, 12, 13. But in case of S4, suppose the returns have decreased. Okay, now this decrease, although I have written in the same amount, that is 1%, it can be anything. It can be 10%, then 8%, then 7%, then 5%, anything. Okay, now what you will see, because of a particular event, one security returns are increasing, the other security returns are decreasing. What does it mean? It means S3 and S4 are moving in opposite direction. Are we clear? This situation is known as negative covariance. That if the covariance is 0, there is no linear relationship. What does this mean? There is no linear relationship. See, between two variables, there can be multiple relationships. Okay, it can be linear or it can be non-linear. Okay, so for example, a linear relationship is usually given as x is equals to ay. Okay, there can be other forms of relation, x is equals to ay square or x is equals to ay cube. Okay, what the statement is saying that if the covariance is 0, this relationship does not hold. If the covariance is 0, this relationship does not holding, but it is nowhere saying that this or this will not happen. Okay, so mind, this is a very popular MCQ question. Okay, they will give you that there are two variables x and y with covariance 0. Okay, what can you infer from the statement? The one will be there is no, if the covariance is 0, there is no relationship between the variable. The second will be there is no linear relationship with the variable. The third option will be none of the above. Or the third option will be that it indicates that x and y move in the opposite direction, or x and y don't move according to each other. Right? So you have to always remember, whenever the covariance between the two variables is given as 0, they don't hold linear relationship, but they can hold cubic relationship, they can hold square relationship. Are we clear? Okay. Now there is a formula given. What is the formula given? We will see the formula from here. What is the formula? Summation. We know what does summation do. Summation of what summation? RT. What is RT? RT1 means the first security, which we have been saying S1 or S2, minus the mean into RT2 minus the mean of that divided by the number of observation minus 1. So what does it mean? We will take one small example to understand. Suppose RT1 and RT2 is there. Okay. And suppose year is given to us. Okay. 2019, 20, 21, 22, 23, 24. Okay. 10%, 9%, suppose it is 12%, 11%, 13%, 13%, 14%, 14%, 15%, 16%, 17%, 18%. Okay. What is the mean of this number? What is the mean of this number? Mean will be sum of all the number divided by 6. I don't think I need to explain you how to compute mean. Guys, let us compute the mean, but once. Guys, we'll compute the mean. Guys, we'll compute the mean. The mean for RT1 is 13.5% mean. And wow, exactly same. Guys, please don't get misled by the example. This was pure coincidence that the mean of both the numbers have come out to be 13.5. It was not at all intentional, or it is not at all required. Okay, in order to remove confusion, let me change it. 13.6. Okay. What is covariance saying? Covariance tells me to find out two things. First, the direction. Second, the extent. See, ideally, even at looking at the data, you can say the direction. RT1 is also increasing, RT2 is also increasing, right? So logically, looking at the data, you can say the direction, but you will not be able to tell the extent. And that is why we are doing the computation. What is the computation? We will compute RT1 minus the RT1 mean, and we will do RT2 minus RT2 mean. Okay. What we will do? We will do 10 minus 13.5, which is minus 3.5. Similarly, 9 minus 13.5, which is minus 4.5. Similarly, it will be minus 1.5, 0.5, plus 5.5, 1.5, and 3.5. Okay. This will be, sorry, 67, minus 4.67. This will be minus 2.67. This will be minus 67. It will be 0.33, 2.33, and 5.33. Now we have to multiply these numbers. Okay. When we do the multiplication, what do we get? We get 3.5 into 4.67. We 18.6 into 6 minus 1, which is 43, which is 8.608. Now you can see two things over here. This number over here is positive. Okay. Positive covariance means positive direction. Okay. So by computing this number also you will get direction, and this will give you a sense of extent as well. Are we clear? Are we clear with the covariance? Now, attached to the covariance concept, we have something known as correlation. Correlation is nothing. Let us understand, guys. Correlation is an important concept, so we need to understand correlation is nothing. It is covariance, but standardized. What does it mean, but standardized? It means that covariance divided by the standard deviation of both the variable. What is this? It is covariance divided by standard deviation of return of security 1 into standard deviation of return of security 2. Why this is done? What is the object? The object of doing this is to standardize between a number of minus 1 and plus 1. Correlation will always be equal to or less than minus 1 or plus 1. What is this? This is the sign of correlation. This is known as correlation. Are we clear? Why do we standardize it? We standardize it with using the standard deviation in order to ensure that they become range bound, so that we can derive conclusions on the relationship between two variables. See, over here it is 8, right? We got the covariance number as 8. Now, as an absolute number of 8, it becomes not very much expressive about the relationship between the two variables. But when you convert it into a standardized form of correlation, it becomes very much expressive. How it becomes expressive? It becomes expressive by the fact that when the correlation is minus 1, it is known as perfectly negative correlated. When it is plus 1, it is known as perfectly positive correlated. And when you move towards either plus or minus 1, we say that correlation or the extent to which they are related is increasing, or the extent of relation is increasing. Are we clear? So in order to be able to, I will repeat it again. So to be order to able to provide a conclusion or provide an inference about the relationship between the two variables, correlation was introduced. Okay. What is correlation? Correlation is nothing. It is covariance only. But we are standardizing the measure of covariance. Okay. Why we are standardizing it? The object of standardizing the covariance is to be able to better draw a conclusion on the relationship between two variables. Are we clear? Are we clear, guys? Now, what is correlation? Correlation. Covariance when standardized by the standard deviation of two securities. We know standardized means co-movement of A. It is bounded by +1, -1. We have already seen. +1 is perfectly positive correlation, -1 perfectly negative. 0 is no linear relationship. Over here as well, if you see, we are only saying no linear relationship. We are not saying no relationship. Guys, please understand this fact. We are not saying no relationship. There might be a possibility of relationship, but that will not be linear. Are we clear? Okay. Couple of things which we need to understand in paralysis of the risk. It is usually observed that the greater the average return exhibits the highest risk, SD. What does it mean? This statement means higher risk, higher return. It is usually observed. Okay. The second point, the real return tend to be more stable than nominal return since annual inflation fluctuates great over the period. What does it say? It says that the variability of real return is lower, or in other words, or which can come as an MCQ as well. The variance of a real return will be lower than the variance of the same nominal return or even the SD. The third, evaluating investment based on expected return and variance is a simplification because return do not follow normal distribution. What does it mean? See, you need to understand one thing. Okay, whenever we are computing standard deviation, okay, whenever we are computing variance or whenever we are computing the expected return, we are assuming that returns are normally distributed. Now, what is normal distribution is something which we will cover in the quants part. Okay, but for now, just understand whenever we are computing the expected number or whenever we are computing the risk numbers, we assume the return to be normally distributed. But that assumption in real life might not hold true, and that is why the entire analysis that we are doing might fail. But don't worry, guys, in your entire 3 levels of exam, whenever this type of question will come for calculation, you will always assume that returns are normally distributed. Okay, so this point which I have marked over here does not have a mathematical implication for you. Okay, the returns are usually negatively skewed and have positive kurtosis. What is skewness? What is kurtosis? We will see, guys, in the quants reading. Okay, but this point is again related to the normal distribution. Liquidity is an additional characteristics to consider when choosing investment and is usually a major concern of emerging markets. Yes. So what it is saying that now we know about returns in a portfolio. Now we are aware about the risk. Okay. What it is saying that what an investor will do, an investor will usually select a security based on return and based on risk, since we are aware about both. Okay, and select the security which will provide the highest return at a given level of risk. But what it is saying that in real life scenario, liquidity is also an important factor. Now, what is liquidity? Guys, we have covered it in details in our liquidity and working capital chapter when we were doing in corporate finance. And I expect you guys to see that video in order to understand what does liquidity means. But over here, what it is saying that yes, liquidity becomes an important characteristic while making investment decision. It is not only based on risk and return. Okay. The last part. Now we have understood about correlation and covariance. Since we have understood about correlation and covariance, there is one important pertinent question which ideally you should ask. Okay. And I will be very shocked if it doesn't come into your mind. You will ask me, how does correlation between two security impact the portfolio risk? You should ask this. Okay. We will answer it in 2 methods. One is the mathematical method. One is the logical method. And after we understand both the methods, we will see the graph for it. Okay. First, let us come to the mathematical method. As per mathematical method, what is the variance of a portfolio? Variance of a portfolio. What is the variance of a portfolio? Variance of a portfolio is nothing but weight of security 1 square into SD square plus weight of security 2 square into SD square plus 2 into weight 1, weight 2, SD1, SD2, and correlation between 1 and 2. Okay. When can we say the risk of a portfolio increases? When the variance of the portfolio will increase. Okay. And when will the variance of a portfolio will increase? If we assume the weight to be constant, the SD to be constant, the weight for the second security to be constant, its risk is constant. So this term plus the other 2 term in the beginning will become a constant. So the risk of the security will be completely dependent on the correlation between the securities. So when we increase the correlation between the securities, can we say the risk of the security will increase? Can we say that, guys? Can we say that if we increase the correlation between the securities, guys? And can we say in this situation there should be a positive correlation? On the other hand, if I want to decrease the risk and if other things are constant, then I will have to reduce my correlation, or either will have to reduce the positive correlation or I will have to increase the negative correlation. Why? Because if this is minus, okay, this correlation is minus, and if I keep on increasing this number, it will reduce the entire number from here because this is positive. When the correlation between two securities is negative and I'm increasing it, the entire terms become smaller. Guys, are we clear? The entire term will reduce. So reducing the variable variance can be either through increasing the negative correlation or reducing the positive correlation. Increasing the negative correlation or reducing the positive correlation. Yes or no? Are we clear? This was a mathematical derivation that how correlation. Now let us talk logical. Okay. What is risk of a portfolio? In broad sense, risk of a portfolio means that because of a particular event, the returns that I'm expecting, I will not get it. Yes or no? Okay. Now we will say that the correlation is negative. Okay. What will happen? It means if one security is doing good, the other security will not do good. Similarly, if the first security is not doing good, the other security will do good. Correct? So even in the baddest of the baddest situation or worst of the worst situation, one security will be there which will do good and thus will pull down my overall risk. Correct? Similarly, if my correlation is positive, both the securities will move in the same direction. So in case of a bad event, both of them will do bad and my risk will be increased. But if I reduce the positive correlation, in that situation, what will happen? Both of them will not do bad to a very great extent because their correlation is low and thus my risk will be controlled. Correct? This is the logical method. Now we have done both mathematical and logical. Now we will see from a graphical perspective, and this is a very common diagram, so nothing special. So what it is showing over here, ERP is nothing but the expected return, whereas the sigma P is nothing but the standard deviation of the portfolio, which is nothing but a measure of risk. Okay, so this is a measure of risk, and this is expected return. Okay, what it is showing at this point, it is showing that my portfolio has 100% allocation of security A. At this point, it is showing that the portfolio has 100% allocation of security B. Okay, when a portfolio has 100% allocation of security A or B, it means that the portfolio risk is equal to the individual security risk. Are we clear? This line shows that portfolio has sum of security A and sum of security B at each point. Okay, when we are moving towards the left hand, it is indicating a reduction of positive covariance and movement towards the negative covariance. Okay, so what we will see over here is that when two securities are completely perfectly negatively correlated, what we are seeing that when two securities are perfectly negatively correlated, we have the highest expected return at a particular level of risk. Guys, see what it is showing. As we can see from the correlation of return between the assets, when the correlation of return between the assets are lowered, the risk for the same returns are also lowered. Okay, what does this line mean? It means when the correlation of the returns between the assets are lowered, we are moving towards a lower correlation. Correct? The risk for the same return, what does it mean? That for 1% of return, the risk is reduced. So in other words, can we say at the given level of risk, my returns are maximized? Can we say? This graph shows that. It shows that as soon as you reduce the correlation between the assets and move towards the negative correlation, your risk reduces for a particular level of return. Are we clear? I hope, guys, we are clear. With this, we complete the two most essential and the basic topics in portfolio management. One was the risk, one was the return concepts. The other is the risk concepts. In the next class, In the next class, we will be starting with the concept of optimally risky portfolios, indifference curves, and efficient frontiers and all. So I hope, guys, this video was helpful to you guys, and I will be coming out with new videos.
Very important theoretical concepts, most notably the efficient. In this video, we will be talking about diversification, but doing so in a sort of theoretical, non-numerical way.
very important theoretical concepts, most notably the efficient return at a portfolio level that would the portfolio that actually has zero risk, zero variance, or zero standard deviation in it. So it's a risk-free portfolio. That's actually what happens when you've got, for example, when you're using derivatives that are a perfect offset to some underlying asset. You can eliminate any variance in the overall position. Now,